before the flashing stock market tickers and cryptocurrency algorithms, before digital ledgers and high-frequency trading bots. There was land. For generations, the dirt beneath our feet has served as the ultimate economic bedrock. We are taught from a young age that buying a home is the single most reliable path to building lasting wealth. It is framed as a financial fortress, an asset that shields us from the chaotic storms of the broader economy. And, for a remarkably long time, that comforting narrative was entirely true. But right now, the concrete foundation of that fortress is silently fracturing. The global housing market is reaching a historic breaking point. You have almost certainly heard the golden rule of real estate, repeated like a sacred mantra by parents and brokers alike. They confidently tell you that real estate only ever goes up. They paint a picture of a continuous, gentle escalator carrying homeowners toward inevitable prosperity. But if you pull back the curtain on today's housing data, that escalator looks more like a terrifying mechanical failure. We are not currently watching a traditional crash, where home values plummet into the abyss overnight. Instead, millions of homeowners are suddenly trapped in a suffocating economic paradox. They sit on massive piles of paper equity, yet they are completely paralyzed. They are unable to sell, unable to afford moving, and watch their actual purchasing power evaporate. The market ecosystem has frozen solid. This gridlock is not just a temporary glitch or a minor seasonal slowdown. It represents a fundamental, structural failure in how we buy, sell, and finance shelter. Everything you thought you knew about investing in property is based on an artificial era of economics that died just a few short months ago. The traditional playbook of leveraging cheap debt to climb the property ladder has been shredded. This leaves buyers and sellers stranded on opposite sides of an unbridgeable financial chasm. To understand how to survive this massive tectonic shift, and how to strategically profit from the incoming systemic wreckage, we have to strip away the comforting myths. We must look directly at the raw, invisible economic machinery that really controls the homes we live in. For over a decade following the dramatic crash of 2008, a unique and highly unusual economic climate nurtured the global housing market. Central banks slashed interest rates to the floor, flooding the system with extraordinarily cheap debt. Borrowing money was practically free. If you wanted to buy a home, you could secure a mortgage with an interest rate of 3% or even less. This historic anomaly acted like a powerful fertilizer. It allowed buyers to stretch their budgets, bidding up property prices while keeping their actual monthly payments comfortably low. Home ownership blossomed into a frictionless machine of wealth generation. But to understand why this machine is now breaking, we need to examine its central, delicate gear. When you buy a house, you are rarely just buying the physical bricks and wood. You are buying a monthly payment. That payment is tethered tightly to the cost of borrowing money. If the price of the house remains exactly the same, but the interest rate on your loan creeps upward, your monthly obligation inflates dramatically. This simple mathematical relationship acts as an invisible, ruthless gatekeeper. As rates rise, the pool of people who can actually afford that monthly payment shrinks. Slowly, but surely, ordinary buyers are disqualified, pushed out of the market by the sheer gravity of compounded interest. Then came the spark that ignited the current crisis. Like a sudden shift in the weather, aggressive macroeconomic inflation swept across the globe. Everything from groceries to gasoline became vastly more expensive. To fight this fiery inflation, central banks, led by the Federal Reserve, were forced to reach for their only real weapon. They began hiking interest rates at a blistering, unprecedented pace. The era of free money did not just gently fade away. It was violently and abruptly terminated. Within a matter of months, mortgage rates doubled, and then climbed even higher. The delicate gear governing the housing market was suddenly jammed with a massive wrench, violently halting the once smooth flow of capital and radically rewriting the rules of real estate overnight. Imagine you bought a house a few years ago. Your mortgage is anchored at a microscopic 3%. If you sell today to buy a new place, your next loan will be shackled to a staggering 7% rate. You would pay thousands more every month just to live in a similar home. So, you do the only logical thing. You stay put. This creates a pair of golden handcuffs, a phenomenon known as the lock-in effect. Almost instantly, the supply of available homes vanishes because existing owners are barricaded behind cheap debt. Simultaneously, prospective buyers look at the towering monthly payments required by modern rates and walk away. Mortgage applications crater. Buyers cannot afford to buy, and sellers cannot afford to sell. This street-level stalemate rapidly snowballs into a massive catastrophe. When millions of homes stop changing hands, an entire economic ecosystem starves. Real estate is the lifeblood for moving companies, contractors, and hardware stores. A nationwide transaction freeze sucks the oxygen out of the broader economy. Institutional investors, who spent the last decade scooping up properties, suddenly find their portfolios stagnating. The traditional life cycle of real estate, where families consistently trade up from starter homes, completely shatters. The gears of the housing machine simply rust in place. This brings us back to the paradox we started with. We are conditioned to believe a broken real estate market looks exactly like the devastating crash of 2008. We expect a fiery explosion where housing values collapse into a terrifying freefall. But the data reveals a much stranger reality. Because current owners are financially paralyzed, there is no tidal wave of desperate sellers flooding the market to doctor prices into the ground. Instead of an explosion, the housing market is dying of hypothermia. Prices remain stubbornly high, propped up by an artificial lack of supply, while the actual number of homes being sold drops to agonizing lows. We are not witnessing a violent price crash, but a systemic deep freeze. It is a zombie market where the asset ceases to function as a tradable commodity. But this paralysis is exactly where the opportunity lies. When a massive machine like the housing market seizes up, it creates structural fractures. You just need to know where to look. While ordinary buyers and sellers are trapped in their standoff, a new reality is unfolding beneath the surface. Real estate is no longer about blindly throwing a dart at a map and waiting for the line to go up. The golden era of effortless appreciation is dead. We have entered a period of extreme, hyper-local fragmentation. So, how do you actually maneuver within a frozen landscape? The secret is to stop looking at houses as simple shelters and start viewing them through the lens of distressed capital. When millions of homes are locked away, the few properties that do hit the market are there out of absolute necessity. People still face unexpected life events. Estates must be liquidated, and over-leveraged investors eventually bleed out of cash. These forced transactions are the cracks in the ice. To profit from this broken system, you have to pivot your strategy entirely. Instead of hunting for a starter home in a saturated suburb, you target the pressure points. You look for regional pockets where commercial builders overextended themselves during the boom and suddenly hold a surplus of vacant inventory they desperately need to offload at a discount. Or, you step away from single-family homes altogether. As millions of people are structurally priced out of buying, they are funneled directly into the rental market. Shifting investments into multifamily rental properties or capitalizing on high-yield debt becomes the most rational move on the board. You are no longer banking on the building's price skyrocketing. You are turning the property into a cash-generating toll booth for a growing demographic of permanent renters. In the end, the housing market did not shatter into a million pieces like it did a generation ago. It just quietly evolved into something entirely different. The old rules have been erased, and the wealth of the next decade will not go to the lucky ones who simply bought early. It will flow to those who understand the new mechanics of a frozen world, finding movement where everyone else only sees a wall.